Good to hear fresh perspective on that. And now we're going to be shifting gears a little bit, talking about LPs. What should LPs expect? How should they be surviving in 2025? And I'd like to welcome the host of this panel, Jim Pfeifer. Let's give it up for Jim real fast. Hey, Jim. Jim, I noticed a couple things different about you. Last year you had the buzz cut. This year you got some long, luscious locks going on here.
That's right.
I'm liking the change of pace, but I also noticed different logo here on your sweater. What's going on with Passive Pockets? I didn't think you were representing with them last year.
Well, so last year it was, if people here remember, we did a Left Field Investors Day where we had a day of just LP content for limited partner investors. And Left Field Investors is one of the company that I founded, and our purpose was to serve LPs, to help LPs learn how to become better investors. Because let's face it, being an LP is difficult, right? These are long-term, illiquid investments, completely out of your control. So how do you vet operators? Well, we believe community is the way to do that. And Left Field Investors was a pandemic baby. I started in 2020, and we kind of reached a point where we really wanted to level up. And that's when we partnered with Bigger Pockets, who has resources and capital to be able to help us do that, and we became Passive Pockets. And so that's where we are today. We're Passive Pockets. We're doing the same things that Left Field Investors was doing, but we're doing it in a bigger and better way.
Well, leveling up is what things are all about. I'm so excited for this session, Jim, and I'll let you take it from here.
Awesome. Thank you. Thank you very much. All right, we'll bring out the guys. And if you check your programs, you'll know why when I introduce them, I'm not using last names. We have Chris, Paul, and I'm not going to blame Aleksey, but I can't say his last name, so I'm only introducing first names. You had a brief introduction to me, so the next thing we're going to do is I'm going to let the panelists introduce themselves. And what we're going to talk about today, as Garrett mentioned, is how can LPs survive in 2025? We hear a lot about operators and the deals, how they survive until 2025, and that's changed, of course, with the things that have happened. But now today, for this next 40 minutes, we're going to talk about LPs, what we can be doing now to be successful. So I'll let you guys introduce yourselves. Aleksey, you want to go first?
Yeah, sure. Thanks for having me. It's a pleasure to be here. I guess in a few words, I advise LPs full-time. I write to 7,000 investors at lplessons.co. And my most recent venture has been gplpmatch.com, which is basically a way for GPs to submit a deal and match with up to, and actually over now, 1,000 LPs within a few seconds. That's me.
Hey everybody, Paul Shannon. Am I on? Is that mic on? Can you guys hear me? Okay, good. I'm an active operator in Indianapolis. I also have a fund. I'm a fund manager, and we invest as LPs in other investors' deals. Co-host of the Passive Pockets podcast now with Jim Pfeifer as well.
Hi, my name is Chris Lopez. I live in Denver, Colorado, and I built an active portfolio, and then about 4 or 5 years ago, started transitioning from active to passive. So I like the ability of scale better for passive, and then I've also brought a lot of my Denver investors trading out of the high appreciation, low cap rate properties. They're also going active to passive as well.
Excellent. Well, thank you, guys. And these are 3 experienced limited partner investors. I know they said all the other things they do, but they also focus on investing themselves and helping and talking to other limited partner investors. So the first question I'm going to ask, and we'll start with you, Chris, is how have limited partner preferences and expectations changed since, let's say, 2021? What's different?
That's a loaded question there. The first one obviously is just a lot more due diligence. A lot of people have, been burned or been in sideways deals, or they've read, Bigger Pockets forums or Reddit forums. So I think people are more gun shy and, doing more due diligence. But in terms of investing, I see a lot more people, and myself included, a lot more interested in like debt funds or more fixed income, less interest in equity. And I think in the market cycle, that makes a lot of sense. And this might be unique to me in Denver, and I'm in this avatar, but a lot of my Denver-based investors, we have a high concentration in Denver, so a lot of geographic concentration on there. And also, the Colorado legislature has not passed friendly housing provider rules the last couple of years. And so a lot of people want to move some of their properties, either actively or a lot of times doing it through syndications, into more, Midwest or friendly states to get geographic diversification, better yield, but also just get into landlord-friendlier states.
Excellent. And then you mentioned debt. So, Paul, do you agree that more investors are looking into debt rather than equity? And if so, why the change?
Yeah, debt funds have certainly become popular over the last couple of years, no question about it. I think there is certainly some, benefits to moving down the capital stack, subsequently reducing risk, having the underlying collateral in the real estate, assuming that there's low loan to values. So yeah, it certainly does make sense, as well as if you consider that there's been a lot of lenders who have left the space and it's been more difficult to raise capital. These funds are sort of capitalizing on that trend. We as a fund have certainly enjoyed investing in debt funds and just having a little bit reduced exposure. And I think investors really like it too, because it's current pay, it's distributions, it's cash flow. That's been missing from a lot of people's portfolios. You talked about what's changed over the last couple of years. Well, I think it goes without saying, we know there's been distributions paused, there's been capital calls. A lot of the investors that came into the space as limited partners were attracted to the space because they wanted a supplement to their income. They wanted that cash flow. They wanted financial freedom as the ultimate goal. And what they've gotten is the exact opposite. So when it comes to debt funds, I think it's been very popular with limited partners because you're getting current cash flow distributions in the 8 up into the mid-teens, depending on what your risk profile is.
So cash flow, right? It's the real estate guys. Russell Gray talks about cash flow is equity, right? So Aleksey, if we're doing debt funds or investing in debt, we're certainly receiving cash flow, but we are losing some of the upside. So how does that affect LP investors, and are there other places where we can get some upside as well?
Yeah, maybe I'll mention one thing on debt funds, and then I'll also, if I can, go back to preferences a little bit and how things have changed. So in terms of debt funds, it's actually really interesting. I totally agree that sentiment has changed and people are looking into debt funds more. The question is are they investing in those things for the right reasons? And I think what's common to hear from LPs, I mean, I hear it all day, is like, hey, like it's the first position in the capital stack, right? They have the first lien on the property, so therefore it's safer. Or maybe it's pref, and therefore it's ahead of equity, and therefore it's safer. And I think, if I may, what is sometimes missing in those conversations is just because it's safer does not mean it's safe. I think a lot of times people assume that it's almost, within the context of what you just asked. Back in 2021, I spoke to many people that were investing in real estate as LPs in equity, and the most common thing I heard was the worst thing that happens is I'll just get my money back, right? Like they'll sell the property, they pay off the debt, and I'll just get my equity back. And I mean, we laugh about it now, but I could guarantee you thousands of people that invested based on that premise. And I think what's happening now is the same thing is true, but now in debt, right? They're forgetting that sometimes there's not a note financing, meaning someone is typically lending to that debt fund, right? They're also forgetting that the cash flow may come from the property, or it may come from someone else investing.
Leverage.
Yeah, meaning the source of that cash, I think, is important. And I don't want to talk too much, but just quickly on preferences changing, I would say the biggest thing that's changed is the demand from LPs on the alignment of interest pillar. I like to think of LP investments in 3 different pillars. And circa 2021, I would say average retail syndication probably had a 60-40 split above a 6. 65-35, something like that. Nowadays, it's extremely common for me to see 7%, 8%, 75, 80%, right? So you can see how those demands have shifted in the past 2-3 years. And also the other thing is I think more and more people are demanding a significant co-invest, in some cases up and above what the acquisition fee is in dollars.
And one thing we haven't really mentioned, but one of the nice aspects of debt is there are mostly or most often better liquidity options, right? You can maybe get your money back in a year if you want, or 2 years, or whatever the lockups are, where equity, it could be anything. And I know one of the biggest lessons I've learned over the past 5 years is liquidity, right? If you don't have liquidity, that can be a real problem, because let's be honest, for a few years there, the pro formas were for 5 years, but I was getting double my capital back in 2 or 3 years. And now, cross my fingers, I'm hoping to get my capital back in 7, 6 years. So that's changed a lot. Can you guys talk about liquidity and how you feel about it now, and has that changed as well?
I think it relates to diversification. If you want to compare it to like stocks and bonds in a traditional portfolio, you could look at common equity, pref equity as a slice of your portfolio. You could look at debt funds as being another slice. And when you invest in debt, you give up on some of the benefits of owning physical real estate. Your tenants paying down the note, potential for appreciation, depreciation from tax benefits. You don't get that with debt. But what you do get is potentially a reduced risk profile by being lower in the capital stack. You get more consistent current pay income. So I think it all balances out, and you don't want to be too heavy on one sector or some specific asset or some specific geography, or as an LP with one specific sponsor. You want to be spread out a little bit more, and I think debt offers a solution to diversify a portfolio.
And to add on there, I think, a lot of people are writing, smaller and fewer checks, and this kind of goes back to the syndication ladder or dollar cost averaging theory into investing. I used to see people write a lot bigger checks in the one deal, and now I see, more checks, and myself included. I write more smaller checks into more deals for diversification, and also, hey, I can invest some money this year, some money next year, some money next year, and start building that ladder. So I've gotten a lot more disciplined about building liquidity that way, so I can invest, hey, this chunk this year, this chunk next year, and then it starts rolling off while also keeping very healthy cash reserves for when things go bad.
Excellent. So you've kind of rolled into my next question after my next question, but we'll tackle it now, even though you skipped ahead. So you talked about building a syndication ladder and dollar cost averaging, and it was always my strategy when I first got into this to start with small checks, because I wanted to test operators, right? So we did group investing through TribeVest. We did a lot of different ways to do some small checks to kind of do some tests. And my goal all along was then to start writing bigger checks once I had confidence in the operators. Well, the past 4 years hasn't given me any confidence in anything or anybody, really. So now I think I'm probably going to keep on that small, like you said, ladders and things like that. So can the other guys maybe talk a little bit about how you do that, how you diversify, and we'll get back to some asset class stuff, but how you diversify as far as the amount you invest, when you invest, and the ladder strategy or that Chris was talking about.
Yeah, I think from an LP's perspective, first of all, you have to have capital. When you start out and you're younger, your biggest asset is your job. You have to grow that wealth to a point where you become an accredited investor and you can take, let's say, $1 million and slice it up amongst 20 to 40 deals at lower minimum investment amounts, right? So there's some work that has to go into getting to that point. But when you do, I think you should have sort of like a 10-year outlook on building a portfolio. And I know that sounds like a long time, but when you're going into deals with high minimum investments and you're pretty concentrated in that deal, you want to consider a number of different diversification factors, that being the sponsor you're investing with, the geography of the country, the asset class, multifamily, industrial, retail, the property class, A, B, and C. You want to have some nicer vintage stuff that's more like a coupon clipper. Then you want to have some, higher risk stuff that maybe is a distressed or a C-class property that has some vacancy and is more of a value add play. And then one of the things that I think is often overlooked when discussing diversification is duration risk of the underlying loans that are in the deals in an LP's portfolio. Like when do the loans mature of all the deals that you have? And what I think we saw happen just recently in recent history was that a lot of people rushed into the space in 2020 and they got into a ton of deals. And I know multifamily is popular here, 2021, 22, that use short duration, 3-year floating rate bridge debt, and all that stuff is coming due right now. Those loans are maturing. So that's duration risk in an LP portfolio. So I think if you consider those things as you're looking at deals and say, hey, it's okay to have some longer term positions where it's 10 years out. It's okay to have some 3-year positions. excuse me. But it's not okay to have your entire portfolio maturing on the same calendar year because we don't know what's going to happen in 3, 5, 7, 10 years on a macro event. You just don't want to have everything happening at the same time in your portfolio.
Aleksey, do you have anything to add to that?
Yeah, I really liked what you said. The only thing I would just add is I think first step is invest in yourself. At some point you become accredited. It's not clear to me that like as soon as you become accredited, LP investments make sense. Why? Because I think they take a lot of time. And I actually don't think this is talked about enough. Like, I think the first question is to ask yourself is like, do I have time to learn about LP investments? There's like a ton of resources, communities, passive pockets, right? Like, but like all of this stuff takes time. And sometimes I get calls from LPs that are like, hey, I have $1 million liquid, I sold a business, 20 million liquid, whatever it is, and they're like, where should I put it? Which property should I buy? Like, and I'm like, this takes time, right?
Yeah.
And some people don't like the answer, and that's okay. Like that's just a personal preference. And by the way, I don't know if I'm allowed to say this, but like public REITs are an option. They're there. Like a lot of people sort of naturally say, oh, but they're not as good because that dividend yield is different than the pref. The difference, there's a big difference because a dividend yield, there's also appreciation there, and a pref is just an expected pref. A REIT very rarely will not pay their dividend, right? Whereas a pref, as we know now, sometimes you make the 8%, sometimes you can only pay out 4%, and so on and so forth. So hopefully that helps.
It does, except you are not allowed to say REIT, so we'll strike that from the record. But I think that the patience is one of the things, Aleksey, that I don't think is talked enough, and I think that's what you're referencing, right? If you have $1 million in liquid capital, I don't believe you should then go put that in one deal with one operator. I also don't know that tomorrow you should put it in 20 deals with 10 operators, right? It's about Paul's what Paul said is you have time to allocate that, and you can take years to allocate that. And now one of the benefits of higher interest rates is you can park that money someplace relatively safe now for a while, and you don't have to be so excited, because once you get into this, you're right, there's a lot of education you need, and there's a lot of things you have to do to become an effective limited partner investor. But as soon as you get into it, it's super exciting and it's super fun, and then you just want to start sending wires. But I think patience is one of the things that people really need to think about. So thank you for bringing that up. I want to move on to asset classes. What asset classes, we talked a lot about debt, but what other asset classes do you all see are attracting capital in 2025? And then on the flip side, maybe what isn't? And Chris, we'll start with you on this one.
So I've seen a lot of interest, a lot more in like development, both in vertical development for apartment buildings, and especially like the build-to-rent asset class, which is essentially a horizontal complex with 200 or 300 single-family homes, but run like an apartment complex. And so there's two reasons I think there's a lot of interest in there. One, as it's been talked about a lot, we have a lot of supply coming out in the next year to 2 years. Well, if you start breaking ground this year, these projects come online in 2 years, 3 years, in very favorable market conditions for, hey, rent should be increasing again, might be getting the early stages of a seller's market. And so it's a very attractive time to kind of, I think, thread that needle. And I have a lot of interest in build to rent because we all know there's a housing shortage in the U.S. And a lot of people want to live in a single family home, but they can't afford to, they choose not to. And as they're getting older with, kids and taking kids and bicycles up and down the apartments and the elevators all day, they're tired of it. And so that's where build to rent, which again, development, build up 200 single family homes. I've seen a lot of interest around that, both from me as an LP and also a lot of bigger institutional money, because there's a lot of demand on there and they're also achieving premium rents. So it's the best of both worlds from the resident perspective. They could have the single family living, no wall neighbors, no one above or below them, but they have their own private backyard or fenced-in backyard. They get all the amenities. And then from the operator investor group, you have all the efficiencies, and they're usually Class A and brand new, so there's just a lot of great economics on there. So development BTR is what I've been seeing.
For me, multifamily is starting to look more attractive. I was pretty down on multifamily 22, 23. I think there is demand there from retail investors, who I think is really the audience here that we're trying to appeal to. I'd say it's more in the A-class product, though. Stuff that's coming out of lease-up direct from the developer might be a good deal at a decent basis. You're going to buy it probably below replacement cost. There's not going to be any maintenance for 5 to 7 years, so to speak. And these are just nicer new products, and LPs are tended to be attracted to that. I think the C-class stuff has faced some challenges and continues to face some challenges as far as the appetite for LP money. If it's 1980s vintage, it's a little less attractive, a little harder to raise capital. If it's 1960s, it's almost impossible. But there's a point where it starts to look attractive again, and I think that might be happening sometime in the near future. If you look at where cap rates have gone over the last couple of years, maybe 2 years ago, A and C class were really tight. There was almost no difference in some major markets, which really didn't make sense. There was a problem there. There was a dislocation. And now today we're seeing that A class product, that cap rate is pretty sticky, but that C class product in certain markets, especially ones that have oversupplied, is really blowing out, right? It's expanding, and it's expanding quickly. And at a certain point, the risk becomes worth the reward, but there really hasn't been that much juice to squeeze. So I think it's something worth to keep an eye on as far as looking at that little older vintage multifamily product in the next year or so and seeing if there's some price discovery where there's a good entry point. Because I think we've seen the trough. We've really seen where multifamily's bottomed out. And you can't really wait for all the green lights. If you wait for all the green lights, you've kind of missed the boat. So there's some yellow caution lights right now, but if you structure the deals effectively, I think LPs can get into good positions. Outside of multifamily, I think there's a story to tell around industrial. Onshoring of manufacturing in the country over the next 4 to 5 years is probably going to be a trend that we're going to continue to see. Flex industrial, which is more like your larger building that's subdivided into smaller bays. There's a real demand for that, and there's not a lot of supply, and it's difficult to build it and pencil it out. So for what is out there today, there's demand for. So I'd say those are the two most interesting for me.
Aleksey?
The best deal I saw in the past 2 years was office.
Interesting.
And just parenthetically, I actually shared it with a few friends of mine, and they were like, "Oh, like office, I don't know. It's like there's no tenant in there. It's so scary," right? And I just share it because everyone is obsessed with investing in distress, but when it's in front of them, it hits different,
Yeah, absolutely. So you guys have all been very positive about all the stuff you're excited about. So what are you avoiding? Anything? Any asset classes you guys are thinking is on the downswing?
I'm one of those people that Aleksey just mentioned. I'm too scared of office. I think that's, I want to see a little bit more of a trend to know that I'm not catching a falling knife, so to speak. But I'm sure there's some fantastic deals out there. I know there are. I mean, some of the stuff you read in the news about the bases that operators are acquiring in major core markets are eye-popping, like 90% reduction to where the last trade was at. So that's really interesting. Hospitality is one that I'm a little bit nervous to get involved in, just because I don't know if there'll be a recession or not, and I think that's a property class that's really going to be impacted if there is. And I'm also a big fan of staying in VRBO, short-term rentals when I go on vacation. So I think that trend is kind of creeping up and taking share from hotels. Development too. I don't, I'm interested to hear more about your thesis around development, but I just feel like it's been difficult to pencil those types of deals to get them out of the ground today, which is why we're going to see probably in the next year to 18 months, supply and demand really balance back out because there's just nothing coming out of the ground right now from starts. So, and then retail as well. Some retail would have to be a special situation.
So basically just multifamily.
So everything is what Paul is saying. So that's helpful. So now that we're all in a...
Can I add on something here?
Yeah, of course.
So two things, development. The numbers I'm seeing, a lot of them, they're coming out like a 6.5% on untrended yield cost. So that's basically like their cap rate for building. Like a brand new Class A property, that's better than I'm seeing a lot of value-add deals are on par. So hey, that difference in Class A or Class C, I'd rather have a brand new thing. One thing I'm pessimistic on, and this is part of my due diligence now. Like I said, I'm in Denver, Colorado, and we were purple for a long time, and we just went very, very blue in terms of a lot of the legislature. Legislative risk is now part of my due diligence when I look at markets, cities, and that was not on my radar 2 or 3 years ago. That's been my biggest lessons learned the last couple of years. I've had a lot of pain in Colorado because of that.
Interesting. So now that we're kind of on a not as positive conversation, we'll bring up the dreaded capital call. What do you guys think about operators who say we'll never do a capital call and capital calls in general, right? Because that is a big issue with LPs right now. There's a lot of operators who've had capital calls. In my personal opinion, sometimes that's okay, I understand. We've been through some tough stuff. I get why you would. And others who are holding off, trying not to do it, or they pretend like everything's good, and then on a Friday and then on a Saturday, they're like, oops, capital call. So can we just talk about capital calls in general? And Aleksey, we can start with you.
Yeah, they're part of the business. I don't think it's an option to like or not like capital calls. First of all, just to be clear, if you invest in a fund, there's something called they call capital over time. So to be clear, that's not what we're talking about, I'm assuming.
Yes.
Right? We're talking about an unplanned capital call. So you invested in a property, the expectation was that it's fully capitalized to get you to the exit, and all of a sudden there was a surprise. Now, opinions aside, it's just part of the business. And I think it's really important for LPs to know that not all capital calls are created equal. Some are really bad. Some are pretty dishonest. I've seen them all the time. And some are pretty good, right? And so I think if we can, I think we have to change the narrative around capital calls. I'm not saying you should celebrate when you get a capital call email, but also don't just immediately assume it's bad.
Yeah.
Right? Why? Just to get you to your other question is what happens when you put this pressure into the marketplace? Well, GPs start saying we'll never do a capital call. And my question to that is why not? Maybe I'm your best source of capital. Why wouldn't you come to me first? We got into this together, right? I don't know.
Yeah, I agree. I think there's, it's part of the business for sure. There are scenarios where it makes complete sense, where maybe the business plan has changed and there's a path to more profits, and everybody, buys into the plan. It's very transparent, and the numbers make sense. There's other scenarios where it does not make sense, and I think it's really deal by deal. So it's hard to speak in generalizations here. But what I'm seeing right now that makes me just have some pause is that there's some capital calls that are being advertised as pref equity funds or debt funds, or even you're buying into the underlying business of the sponsor. What does that actually entail? What do they own if every asset's under a different structure? So that is a capital call, but it's being disguised as something else or called something else, and you're not buying into a stabilized portfolio if that's being utilized. Why would these sponsors dilute their common equity holders and punish their existing investors unless they absolutely had to? And I think it's just calling a spade a spade. It's like, hey, look, we got in at a difficult time. This is the business plan we had. Here's what we didn't see happening. Interest rates rising, for example, in the short term. And now we have a problem. And here's how we plan to save the business. And I think if that plan is sound and it's understood by everybody and it's realistic and believable, then that capital call should be considered. If it's not, and essentially you're throwing a life raft to a body that's already died, it's not really sensible to do that. So I think it just comes down to a case by case analysis. And
so I think a couple of things that you guys said here, Aleksey, capital calls are part of the business, and I think that's true. And then Paul, you said, when you have a capital call and then the operator says, here's how we plan to save the asset, right? That's a lot different than a capital call, which is you need to send in money, and if you don't, you're diluted and all these other penalties, but we don't have a plan, or it was the fault of interest rates, or was it operational? Those are things you have to figure out. So Chris, do you have something to add on capital calls?
If someone says they will never do a capital call, that's a huge red flag to me. When, not if, right? I will eventually be involved in one. I'll eventually do it myself. It's always when, not if. Just life changes, business plan changes, macro changes. But I do spend a lot more time now looking at how they're underwriting their reserves, their contingency on the current deals, and what they've done in the past as well. When things were easy, reserves, whatever, but now the people that had, healthy 5%, 6% contingency reserves, they have performed a lot better. And if people have very light contingencies, that's another huge red flag to me. That means, hey, there's going to be problems and probably a capital call at some point.
And another thing that I think LPs might need to just take a step back on and reflect is the stopping of distributions. And we talked about this among the four of us prior to this panel. And, what Brian Burke has always said is that the cash flow from a business is distributed, right? That's what your cash flow is. But if you're paying 7% every month, no matter what, that's not really distributing the cash flow of the business, right? It should go up and down, and it's normal. And sometimes when an operator says, hey, we're stopping distributions, it's for a reason, right? It could be a good thing. It might save you from the capital call. So any comments from you guys on stopping distributions and an LP perspective?
Yeah, I've got one. Like I said, sometimes it's very valid. So there's a deal I'm in Des Moines. 200-unit apartment building, great location downtown, and there was just an amazing restaurant, or so I was told, on the lobby floor there. Well, after all the COVID stuff, the restaurant did not survive. So the operator has spent the last 6 or 9 months turning the restaurant into, I think, 6 or 7 more apartments in there. So they paused cash flow distributions to fund the redevelopment of that space. They could add 6 or 7 more units, which, hey, in 6 months or 9 months, we'll have more cash flow, and that will increase the exit price as well. So there's a really valid reason as to, hey, they paused distributions. Here's why. Here's the plan. And I was 100% okay with it because it makes sense.
Right, and I think the critical thing, I know there's a lot of operators out there, and one thing I would recommend from an LP, who engages with a lot of LPs, as we all do, is communication is the key. If you're just stopping distributions and saying, well, we need more reserves, okay, I get it, but tell us the plan, tell us why, and really explain it, because then you'll get someone like Chris saying, well, it makes total sense, right? It's in our best interest, and they'll understand. And when LPs understand, then they'll be able to cooperate with you and be on your side as you're moving forward. And speaking of operators, right, this is probably the number one thing LPs ask me, and number one thing LPs are trying to figure out is, how do we vet an operator, right? As I said when I came on, these are long-term, illiquid investments completely out of your control. I can't invest in one operator and then wait 7 years to see, okay, yeah, that was a good deal, now I'm going to do another one, right? I have capital to allocate. So, Chris, I know you don't like the restrictions on this question, but so I'll start with Aleksey then. So what is your one best method, or two, for qualifying a new operator? But if you say 2, then everyone's going to lunch late. So I'm going to stick with 1.
I have a 3-step framework that's public, and it's ranked in order of importance. And the first one is the sponsor themselves, which I think confuses a lot of people. The first one is the sponsor themselves, their track record, background, legal, all that stuff. And then the second one is alignment of interests, and the third one is the property itself. I think many people come to me and say, well, what do you mean? Like, I'm investing in a property, right? Like, shouldn't that come first? And I always say, personally, like, I look at a ton of deals, give a lot of feedback to people, and most investments don't make it to the property stage. I don't even look at the pro forma, right? Because it's just so hard to get through to a sponsor that seems trustworthy, has a decent track record. If by the way, if they have some sort of challenges, were they honest about those challenges? I think relating to something you said earlier,
right?
Getting through that stage I think is hard enough.
Paul?
Well, when I first started investing passively, I would ask the sponsor, can I speak to a couple of your investors? And what I found was that they would give me their happiest investors, of course, so that wasn't really providing me much value. Then I wanted to speak with investors that had invested with that sponsor multiple times over a longer period of time, and similar results. And what I found most beneficial is being involved in a community like Passive Pockets. And there's other ones out there, but I think just having a cohesive network of people who have tapped into tons of different investments and have experience with investing with multiple operators in multiple cities, and just you can really learn a lot when you speak to somebody that's not given to you by the sponsor, and kind of learn from their experience. How's the sponsor's communication? What have you seen in the deals that you've invested with them in? How's the performance been? You gain so much information that way through community that I think that's something that I didn't really focus on initially when I first got started investing, and it was a mistake.
Yeah, and I'll get to you in a second, Chris, because Paul just stole my answer. But I will add one small thing to it. Is I will not invest with a new operator unless they were recommended to me by somebody that I know, like, and trust, who's part of my community, who has already invested with them. Now, it doesn't mean they have to have gone full cycle, but they've already invested with them, because then I'll know, okay, I'm sending a big chunk of money in a wire, which is terrifying already, but I know it's going to land, right, because someone else has already done it. I know that if they said they're sending out quarterly reports, they actually send out quarterly reports, because I can ask my referral source. And if they say they're going to send out distributions, I can confirm, yes, they do send them out, or they give good reasons why they don't. So I think that, for me, has completely changed how I invest as an LP, because before I was doing it, podcast university, and podcasts are great, but you can't tell if someone's a good marketer, a good operator, both, neither. So I totally agree with Paul. That is my number one. But Chris, we'll go to you now.
Trust but verify. So, hey, what's your track record been? What your project's been the last 5 years? Everyone had challenges. How did you navigate those challenges? What went well? What didn't go well? Because a lot of people bought right, they executed their plan, and they're coming out not too bad. Other people, too optimistic on, hey, rent growth is going to be 10% forever. Highly leverage. So I look at when the times were tough, did you stick to what you said you were going to do in terms of like a buy box? And I think very few operators did. The good ones kind of stopped doing deals, or they did a 10th or a 9th of the deal flow they used to do, has been my experience. And then, take it a level further. Go trust. Go look at the files. Go walk the property. Go, hey, let's go walk this project here. Go show me this. Or for the debt fund, go out to their office and pull their files and say, great, let me pull these 5 random files here, and let's trace them all back and forth. So what have they done the last couple of years, but then trust but verify with a lot more thorough due diligence of not just them talking to you, but on site, either in their office or on the property.
Excellent. And then, so those are things that you look for. Are there any red flags that if you see something from an operator, it just makes you say, you know what, I'm an automatic pass?
No money in the deal of their own. That is an automatic pass for me.
Anything else?
I mean, personally, I only have 2 red flags. And one of them is the word guaranteed. I have a whole article on this as to why. But just because you personally guarantee something, usually that's not even the case. But even if you do, that's not guaranteed. And I explain that. And then the second one is no return of capital provision, which I've actually seen. Meaning a return of capital is not part of the waterfall. Everything else, in my opinion, including the co-invest, is what I call like a reason to stop and think. Because other factors in the deal might make up for the fact. For example, it might be a guy who's 24 and he doesn't have much money, but everything else about the deal you really like, and et cetera, and the economics are much better than you can get elsewhere, and perhaps it makes sense. That's why I say you stop and think. Paul?
I would just say lack of transparency, and that could go, in the direction of not being willing to provide a background check, or what's a hot button for me is not providing the underwriting because it's some proprietary model, or it's being sold for $10,000 to other people, so I've got to pay if I want to see it. Stuff like that just doesn't fly. I think the numbers should be out there for everybody to see, to make their own analysis as far as, is this realistic, as far as the pro forma and the outcomes that are predicted, and everybody can buy in. So that's certainly a red flag for me.
Yeah, for me, it's just communication. If you're not going to effectively communicate with me before I send you the wire, I'm pretty confident it's not going to improve after you have my money. So that's a no-go for me. We have about a minute and a half left. So real quick, last question. Our favorite topic over the years has been bridge debt. It seems to be making a comeback. Is that a good thing or a bad thing for LPs? Paul, we'll start with you because you're smirking already.
I think there was a moment in time really recently where the 10-year was moving in the opposite direction as a federal funds rate. 10-year just approached like 4.8 maybe a month ago or 2 months ago, whenever it was. And, with the federal funds rate coming down, SOFR was coming down, and it looked like, wow, that spread above SOFR isn't so bad. Maybe the bridge is the way to go right now. But again, going back to what I said earlier, you just don't know what you don't know is going to happen in the future 3 years out from now. So to me, it's, somebody said something that stuck with me once, and, it's definitely controversial, I'm sure, in this room, but the quote was that, bridge debt was really designed for sellers to get maximum proceeds, not for buyers as a tool. And I always just remember that, and I think about that when bridge debt is being utilized. I think it is a tool that can be used prudently in certain scenarios, but it's not something as an LP that I would want widely spread throughout my portfolio.
Chris or Aleksey, anything to add?
I agree. I think there's certain use cases for it, but I'm a big fan because a lot of the deals I've been in that have done well is they had, 65%, so low leveraged fixed debt. And a lot of these guys, they bought in 2019, 2020, 2021, and they got a lot of grief. Oh, you could be a half a point, 50 basis point lower by getting a float debt. I'm like, no, I'll take fixed debt. And that has saved a lot of the projects. So I don't think it's a great thing overall.
Aleksey, you get the last word on bridge debt.
It just is.
It just
is.
is.
It's one of the factors in the deal, and you have to consider it. I don't think it's good or bad.
Excellent. All right, well, that's it for this panel. The last thing I'll say, if you're an LP out there, you've heard everybody here talk about community. Obviously, I'm a little biased with Passive Pockets, but you're a member of the best ever community as well. So to be an effective LP, I think joining a community where the culture fits your personality is the best way to really accelerate your learning and to have the best results. So thank you very much, and now we will provide you with lunch.